Thank you. I have Dr. Asti Mardiasmo with us today, Chief Economist for PRD Real Estate. We had a really good chat back about 6 weeks ago, Asti, and the state of play in the Australian economy certainly has been an interesting one to watch. We've had a couple of rate adjustments, and we've certainly seen some market shift and some excitement onshore, but certainly some trepidation with what's happening offshore. So I would love to get your feedback on how you're seeing things play out and what's going to happen for the next sort of 6 to 12 months.
Thank you, Tom, for having me. So there's been a couple of very interesting shifts, actually, because obviously we've just had another cash rate cut to 3.85%, which a lot of the banks have decided to pass on, which is really good. And most of the banks have decided to pass it on fully. Different times, some banks is passing it on by the end of this month, and some banks are passing it on by early June. So there's a bit of a lag time this time around between all of the different banks to actually pass it on. But we have seen some market improvements though. So when the cash rate was first cut back in February, the clearance rate for Melbourne auctions remained at like 65, 66, 67% all throughout, even like the week after, the second week after, third week after the cash rate cut. Whereas this time around, a week after the cash rate cut, so the second cash rate cut, the Melbourne auction clearance rate actually jumped up from 67% to 70%. And that's on the first weekend after the cash rate cut. So it definitely proves the theory that we did have some very sticky buyers where one cash rate cut was not enough. They needed a little bit more of a push. We know that property prices have been increasing. We know that cost of living is still high. So the second cash rate cut did definitely push a lot of those buyers to become, active and actually do the transaction. So we're definitely seeing that result. So that's a good news for the property market in terms of people who are transacting in real estate, because we know that average day on the market was getting a bit long in the first part of this year. And hopefully we will definitely see those average days on the market start to improve.
So we're seeing, obviously, we've just gone through an election and Labor's held their seat. In terms of certainly the Victorian markets, we're seeing prices driving quite significantly, especially in regional centres. So investors have re-entered the market, and I speculate that's off the back of obviously consumer confidence in property as opposed to the stock market being a little bit volatile. When we look at availability of stock and obviously confidence increasing, there's a lack of land development happening because we've had developers put the queue in the rack over time based on costs and interest rates and obviously people investing and wanting to build their first home, etc. If we've got an accelerating market coming out of the metro centres, but we don't have availability of land to people to construct on, are we going to see a real surge in housing prices over the next 12 to 24 months?
Look, it definitely, in terms of the economics behind it, it's definitely one where, if we do have that massive increases in demand, we don't have enough supply. And yes, consumer confidence has increased. It increased to 92.2 index point as of May, which is after the elections. So that means it's great because it captured the election figures. That is actually a 12% increase in comparison to 12 months ago. So we definitely have more positive buyers on the market who are keen to do transactions. And we have definitely seen like you said, that increased drive in demand, and a lot of the first home buyer schemes and all of that will be reconfigured with the Labor government coming in place. They're going to increase the property price caps for both metro and regional areas, especially under the first home regional guarantee, which means that there will definitely be more first home buyers playing in the market. And you're absolutely correct. Like, even though dwelling cost inflation to construct dwellings have started to decline, it is still very expensive to create anything, especially when we think about not just the cost of building, but also the cost of getting the permits, the town planning, the architecture, the infrastructure fees. all of those sorts of things, right? The Australian market is one of the most regulated fee market when it comes to building residential construction. So, if we think about it from that perspective of supply still very tight, and also the demand going to be increasing. And at the moment, many banks will tell you that they're predicting another 2 cash rate cuts for the rest of the year. That definitely will stimulate price growth in the next 6 to 12 months.
So if we're heading into a market where potentially, and we'll talk about Asti's predictions going forward, but if we're heading into a market where we've got the perfect storm, so we have a lack of land development, we have a lack of consumer confidence based on construction costs and lag time, and investors seem to be, certainly in the regional Victorian market, heading towards existing stock. So yes, we're taking stock off market for potential first homeowners and second homeowners to come into the space. And then we've got a lowering of interest rates, so availability of cash and consumer confidence increasing. Is that not a perfect storm for a high growth market in terms of our residential markets in Australia? Because the backbone of the Australian economy really is housing.
It definitely is. And especially when it comes to Victoria, whether it's Melbourne or regional Victoria, in comparison to a lot of the other states, Melbourne and regional Victoria is what we would still call in a recovery phase, because like Adelaide, Brisbane, so regional Queensland, regional South Australia, for example, they have been on like a higher growth phase in comparison to Melbourne and regional Victoria. Like they're in their double-digit growth, whereas Melbourne and regional Victoria is not in that double-digit growth right now. It's still coming up into that curve. And so we will see more investors looking into, because obviously as investors, right, you want to get in the most affordable cycle possible while still getting that high returns and low vacancy rates. And that is the mix that regional Victoria has, is that compared to other regional centres, it's the one that is the more affordable one and still giving you that high rental yields and low vacancy rate. So it definitely is that perfect storm. And in a way, regional markets is a little bit more insulated from any shocks outside, like internationally, because we're all still aware of the potential shocks that Trump and tariffs and geopolitical uncertainties and tension in China and all of that is going to bring into our market, right? But it was proven during COVID that even though Melbourne, for example, really fell in terms of prices, it was actually regional Victoria that was holding the house prices. And so it definitely is that perfect storm right now, Tom.
It's interesting you say that, because it's the opposing to the American economy and the Australian economy. The old analogy that America sneezes and we get a cold. When Melbourne sneezes, we stabilise. We yes, miss that virus, and we've seen that over the last 20 years that we've had sustainable growth, and we might have only had 1% to 2%, or we've just maintained our position. The crystal ball. Everyone wants to know where we're headed, and you've obviously got a seat at the table with the RBA that very few people ever see. What's your insights and what do you expect to happen over the next 12 to 24 months?
So from a cash rate perspective, we're really looking very closely at inflation rates, right? Because we've managed to maintain inflation rate at 2.4% on a quarterly basis, and on an annual trim, that's 2.9%. And we want inflation rate to be 2 to 3%. So the RBA is really watching what's going to happen with inflation rate, because of course for them, the danger or the fear is that if we let the reins go, so to speak, a little bit, then everyone starts consuming and spending and, buying everything that they can right now. And that will push up inflation over that 3%. So if that inflation rate is still within that 3%, then there's definitely a higher chance of cash rate cuts in 2025. In their original statement of monetary policy earlier in the year, they were already forecasting that there might be, and I say might with a big capital letter and underline, that there might be 3 cash rate cuts in 2025 and another one in early 2026. And so in terms of the property market, we're definitely seeing, like I said, we've already seen an improvement in auction clearance rates and transaction sales just after 2 cash rate cuts. And this is actually one of the crucial ones because many know that cash rate cuts stimulate demand and higher prices. And so they want to go in now while the demand is not too crazy yet and prices haven't gone up so much, and then benefit from like lower cash rate cuts and variable rates later on down the track. So in terms of that crystal ball in the next 6 or 12 months, if those cash rate cut comes into play, and we don't have, I mean, our economy is quite resilient to shocks. We've seen it. We've seen when some of the tariffs come through, the ASX did drop a little bit, but then it recovered within the next couple of weeks because we all sort of like rallied in terms of our trading partners and things like that. So our economy is actually quite resilient to absorb some of the shocks. There's no one in Australia right now that has negative equity. And that means there's no one in Australia where their loan amount is higher than their equity amount. So if you are in trouble, you can sell your house and you'll be able to cover your costs, so to speak. So that means not only are we resilient, we might have these other rate cuts that will allow us to access more money and therefore increase prices in terms of property in the next 6 or 12 months. So
which is really the avoidance of a subprime market that we've seen in America years ago because we've got that equity position in all our property. We don't have that closure of the gap.
Exactly. So that will be my crystal ball for the next 6 to 12 months. Hopefully, we will definitely see less average days on the market. I know that there's many sellers that are frustrated at the moment, especially with the longer days on market and buyers being a little bit more stickier than usual. I have had quite a few clients who've said to me, you know, we're really wanting to see these transactions go through after such a long period of being on the market or, you know, kind of like negotiations. So hopefully that is definitely what's going to happen in the next 6 to 12 months.
And it's really interesting. We're obviously operating in the Bendigo market and surrounds, and we're probably averaging around that 28 to 34 days on market. And we've just opening an office in Kyneton, which is only 45, 50 minutes down the road, which you've just done some fantastic research for us on. And it's actually getting closer to Melbourne, which their days on market can average between 80 and 120. And it's just that diverse economy that relies on probably the Melbourne market shifting into that space. But we are starting to see an uplift in that market, certainly in the Kyneton and Castlemaine area, as confidence comes back into Melbourne.
Yes. And the thing is, right, at the moment, when it comes to confidence, once one market starts to shift, there's always that multiplier effect into the other markets. When they start to see one market kind of becoming quicker, then a lot of people in the other surrounding areas in the nearby councils or in 45 minutes down the road or half an hour or 30 minutes down the road will start to go, oh, that market is starting to move. You know, if my market is going to move as well, I need to start now. I need to take some action now. And that gives that multiplier effect into other markets.
And it's interesting, we always see that your own backyard you notice last. So it takes an external investment market or something to come in, and then everyone in the town goes, wow, this economy is great here, the housing market's fantastic. Whereas if we had the foresight to watch that wave coming down the road, then we'd be investing into our markets before it got here.
Exactly. And, but the thing is, though, Tom, I think, everyone always says that they wish they have hindsight, right?
I'd have hair.
If we knew what was going to happen, post-COVID in terms of prices, I think all of us would have bought before COVID,
Absolutely.
But, at the end of the day, I think it's just watching for those key indicators, right? And for me, it's, really watching it almost on a week-by-week basis right now. And the reason why it is on almost like a week-by-week, fortnightly basis is because we know that in 2025, there's only 5 more RBA meetings. And so you kind of, and they're always around like, you know, every 6 weeks kind of thing. So that's sort of like your sort of like milestone benchmarks to kind of have a look at what's happening, you know, 2 weeks before, 2 weeks after. And so, you know, we're in that sort of like space right now where, I mean, back in 2024, the space was everything was being held stable. Whereas in 2025, the space is to create more demand in the economy to lift our GDP. And so that's why you're watching the key indicators just a little bit more closely in 2025.
Yeah, well, really appreciate your time, Dr. Asti. Your knowledge is incredible. You're a huge asset to the PRD group, and your delivery is even better because it means that I can understand it and the rest of the world can understand it, not just chief economist knowledge and speak. So really appreciate it, and we really look forward to catching up again in about 4 to 6 weeks to see how things are travelling.
Awesome. Thank you so much, Tom.
Thanks, Asti.